there's been fog and the flights have been delayed. So I do apologize for that. But we have the team here with us on Zoom. So introducing Sambhav's team limited. Sambhav's story is a reminder of what focused execution can achieve. From a single location in Chhattisgarh, the company has built one of India's only fully backward integrated structural pipe and tube operations, uniquely producing HR coils through a secondary route. And they are not slowing down. With plans to add over 1.2 million tons of finished capacity in the coming years, backed by sustainable capital power and strong distribution ecosystem, Sambhv is gearing up to light the next wave of India's steel and infrastructure. Introducing the management team, we have with us Mr. Vikas Agarwal, Chief Strategy Officer, an MBA and CFA charter with 15 plus years in finance, and Mr. Mayank Agarwal, AVP, CEO's Office and Investor Relations, a CA who manages business performance, strategic initiatives, and investor communications. Over to you, sir.
Thanks, Akshita, and thanks the Go India team for having us on the conference. And apologies to everyone who has joined the conference today. We could not make it personally, but we'll start with the presentation first, and then we'll take your questions if you have any queries and discuss about the companies more in detail. So starting with the presentation, this is our Q2 and H1 presentation that we have already uploaded in the stock exchange and in our website. Starting with the H1 numbers, so this year has been exceptionally well for us in the first half. So we clocked a revenue of around 1140 crores in the first half, with an EBITDA of 133 crores and a PAT of 63 crores. On the per ton margins, on a blended basis, the per ton margins were 7,000 rupees, including all our products. And if we exclude the sale of sponge iron, which is a raw material for us, then the EBITDA per ton comes to around 7,500 rupees, which is one of the best in the industry amongst all our peers. ROC for us is at more than 18% now, and the working capital cycle is at 39 days. So there is a slight increase in the working capital cycle from Q1. In Q1 it was 25 days. However, in Q2 it is 39 days because of the payable cycle. We have shortened our payable cycle and repaid some of the payables to optimize our finance cost. On the operational metrics, we have achieved highest ever volumes in the H1. The sales volume was 191,000 metric tons, including all our products. Similarly, the Q2 numbers were also robust. The revenue was 580 crores, EBITDA was around 60 crores, and the PAT was around 30 crores. And sales volume was around 99,000 metric tons. On the key updates for H1, as I mentioned that we had already achieved the highest ever yearly performance, be it in terms of volume or in terms of revenue, EBITDA and PAT. Quick update on our greenfield project that we are setting up now. We have received the environmental clearance for the same, and the work of setting up the plant has begun in full swing now. And we are sticking to our target of commissioning that plant by end of next year, that is December 26. During the first half, we have received government approvals for product approvals from 11 government departments, including the Bombay Municipal Corporation, CIDCO, CPWD, BHEL, and other prestigious government departments. In terms of our capacity utilization of the newly launched segment that we commissioned in last November, we have already achieved the optimum level of utilization for both of these segments, which is GP and stainless steel. The stainless steel segment is operating at more than 85% now, and GP is operating at more than 90%, which is the highest the industry can achieve. A quick update on the stainless steel production side also. Earlier we were producing just 202 grade. From Q2 we have also started manufacturing 304 grade of stainless steel. This is an update on the capex program for next 4-5 years. So the current finished goods capacity is 5,08,000 metric tons. The breakup of which is 3,50,000 metric tons of pipes and tubes, 1 lakh metric tons of pre-galvanized coils and pipes, and 58,000 metric tons of stainless steel coils. So this is the existing capacity, and we plan to add the finished product capacity by 1.2 million tons in next 4 to 5 years. So this will be executed in phases. The first phase will have a capacity of 360,000 metric tons. This will be entirely for stainless steel coils, and we expect a capex of around 810 crores for the entire capex. And apart from that, we also planning to set up a 25 megawatt captive power plant, which will cost around 125 crores. So the total capex in next 1.5 years will be 935 crores, and then phase 1, phase 3 will keep you updated as we decide on the product mix and the capex plan. So this is the some key ratios of H1. You see the revenue has grown by 76% on a year-on-year basis. The gross margins, EBITDA margins, and PAT have grown on a year-on-year basis. Similarly, on quarter-on-quarter and year-on-year basis also, the numbers have grown significantly. This is the income statement and the balance sheet. I will skip this. The next is on the business overview. As I mentioned, the Sambhv we started our operations in 2018. And in 2018, when we started our operations, we were just manufacturing sponge iron. In 2019, we expanded the capacity of our sponge iron division. In 2020, we set up our power plant and set up induction furnaces to manufacture slabs. Then in 2022, we started manufacturing HR coil. From FY23, we started manufacturing pipes and tubes. In FY25, we did a major capex program and expanded the capacity of all our finished product and raw materials, and also started manufacturing stainless steel and galvanized coils and pipes. And in FY25, we got our shares listed in BSE and NSE. So if you see, in a span of let's say 7 years, we started just by manufacturing sponge iron, and today we have a whole portfolio of stainless steel, GP, and black pipes with complete integration. So this is our production process. The raw material for us is coal and iron ore. We procure that, we convert it into sponge iron. From sponge iron, we manufacture slabs. From slab to HR coil to pipe. So there is an additional step. We do the cold rolling of the HR coil. From that cold rolled coil, we manufacture GP coil. From that GP coil, we also make GP pipes. Similarly, in SS, we have a complete integrated setup. We manufacture our own liquid steel, liquid metal of SS, then cast it in the form of slab to HR coil to HRAP coil, and the finished product is stainless steel CR coils. So if you see, we have 3 product basket as of today. First is our pipes and tube segment, wherein we start from sponge iron and plain till black pipes. We also have value-added products like GI pipes and steel door frames in the pipe segment. The next segment for us is GP coils and GP pipe segment, wherein again we have a complete integrated setup. So up to HR coil, the process remains same. After that, there is an additional step of cold rolling. We convert that CR coil into GP coil, and from that GP coil, we make GP pipe. This is the third segment of stainless steel, same complete integrated setup, the slabs to HR coil to HRAP, and HRAP to CR coil. So these are the 3 product segments. If you see our strengths, so these are the 7 key strengths that we are operating with. We'll discuss about each of these strengths in the coming slides. So the first strength for us is an integrated setup. Now, since we have a complete integrated setup, the integration has a lot of advantages for us. So the first is that since we control the production value chain, we are in a better position to supply any customized products to our customer at a much faster rate, rather than buying coil from the market, which takes typically 1.5 months to get that coil and then convert it into pipe. Similarly, since we make our own coil, the quality becomes very consistent rather than buying coil from the market every time from different suppliers. And third, the cost benefit that comes along with the integration is obviously there with us. So this is how we have grown over the years. You can see that in March 22, the capacity was just 390,000 metric tons, which has grown to around 1.7 million tons in March 25. And as I mentioned that we also have a 25 megawatt power plant as of today. Out of that, 16 megawatt is waste heat recovery based. In waste heat recovery based power plant, what we do, we use the waste heat from our sponge iron killets as a fuel. So through that heat, we convert water into steam, and from that steam, the power is generated. So no external fuel is involved. And also we have a 9 megawatt AFDC based power plant. So in this also we use the byproduct of our sponge iron division, which is dolochar. So dolochar is basically the coal which we take out from the kilns in an unburnt form. So it's the byproduct of sponge which we use as a fuel in this power plant to generate power. So the cost of generation is very low, and this captive power fulfills around 55 to 56% of our power requirement of our unit 1, and rest we are currently getting through discount. Then the next strength for us is the geographical location. So we are situated in Raipur, which is in Chhattisgarh, and since we are integrated, the raw material for us is coal and iron ore. And the mines of both of these raw materials are at the radius of within a distance of around 50 kilometers from our plant. So the logistics becomes very easy and the cost is also optimized. We have another manufacturing unit in Raipur only, wherein we manufacture our GP and stainless steel finished product. That is also at a distance of just 10 kilometers from our unit 1. And as I mentioned that we are also setting up a greenfield unit, which is also at a radius of just 20 kilometers from our unit 1 and unit 2. So going forward, all the three units will be in proximity. So the synergies would be there amongst these three plants. The third strength for us is our process innovation and our execution capability. So we are the first and the only company in India to manufacture HR coil through secondary route. But even then, we have been able to deliver a quality at par with the primary producers. So which is unheard in the markets as of today. Apart from that, we are also amongst the very few companies in India to manufacture SS coil, SS lag products. Third is we also have the capability to produce alloy steel. So we have metal refining furnace with us, which can produce alloy steel. And to give you an example, we have recently manufactured cotton steel pipes. So cotton steel is something that is used in containers manufacturing, containers that we use in the marine transport. And there are only a few companies in India who can manufacture cotton steel pipes. And the fourth is our captive power plant, which I have already explained in my last slide. Then the next strength for us is our distribution network. And as I mentioned that we started manufacturing pipes and tubes from FY23 only. And within a span of just 2.5 years, we have been able to create a network of 43 distributors and a network of more than 700 dealers, which are spread across India. So as of today, we are catering to more than 16 states. And if you say about our major markets, the major markets are Gujarat, Maharashtra, Haryana, Rajasthan, MP, UP, Chhattisgarh, and overall 16 states we are catering to. So this is an industry slide. Just to give you some numbers, the Indian pipes and tubes industry is growing at a CAGR of around 8 to 9%, while the stainless steel segment is growing at a rate of 13 to 14%. So the growth is very good in the Indian steel industry, and on these pillar lines, we are also expanding our capacities to cater to that growing demand. The next one for us is our promoter and the management team. So as a group, we are into steel manufacturing for more than 2 decades. So we understand the business very well and know the nitty-gritties of the business. And apart from that, we have a very strong technical team and the management team. And also we have 4 independent directors on our board as of today. So you can see 3 in the slide, 1 independent director and 1 executive director we have recently introduced to our board, who have very rich experience in the industry. So these is the track record for financial performance of past 4 years. You see, we have a track record of continuous growth of either revenue, gross profit, EBITDA, and PAT. Sales volume has been continuously increasing. Cash flows have been increasing, and finished goods in the finished goods segment, the more than 70 to 80% of our volumes comes from value-added products. Working capital cycle is continuously declining. In Q1 and Q2, there was a slightly bump on that, which I explained the reason for that. On the future outlook, the first priority for us is the capacity expansion. So capacity expansion has always been a focus area for us. We have been doing so in past and will continue to do so in future with our greenfield project in pipeline. The second priority for us is our distribution network. So we are now working aggressively in expanding our distribution network. With the introduction of GP, we are now focusing more on the coastal belt of India, And GP also has some export opportunities, so we'll certainly try to tap into the export markets as well. The third priority is value addition and customization. So again, this is also something that we always focus on, and we keep on introducing newer products in the market. And in future also, we'll evaluate newer products and value-added products and launch in the market in our product portfolio. The fourth priority is cost optimization. So again, cost is also a very strong focus area for us, be it in terms of our captive power plant. Also, the GP plant that we have set up is based on a technology which uses very less quantity of zinc as compared to the traditional method. So we keep on researching and on the cost saving, cost optimizing opportunities, and we capitalize on that in future also. And last is on the brand building side. So on the brand building also we are working aggressively. We participate in every domestic and international trade fairs and events. And apart from that, we have a dedicated team of more than 15 people who visit to who make a frequent visit to our fabricators and retailers and educate them about our product, that how our product is at par with those of best of the players in the industry. And apart from that, the general marketing techniques like coding, electronic media, digital platform, that also we are doing to create a brand awareness. So this was it of the presentation side. We'll be happy to take questions and any queries that we have. Hello. Yes, it's audible.
Yeah. So, coming to your capex plan of 810 plus 125 crores in powers capacity expansion. So, how we are going to finance this project capex program? Can you explain?
So the voice is a bit but I think I got the question. So the capex, you asked about the funding of the capex program. So as I mentioned that the total capex that we are anticipating in next 1.5 to 2 years is around 935 crores. And out of that 935 crores, we have already spent around 200 crores from our internal accruals. So balance spend would be around 735 crores, which we anticipate to fund through a mix of debt and internal accrual.
What will the peak debt, sir, on balance sheet during this capex program?
So in terms of term loan, what we anticipate is to raise around 600 crores of debt for this capex program, and balance will fund through internal accruals. Right, Vikas? Yes.
Secondly, of our total business, what share of business we are having from the government, government and government entities?
So currently, our business model is through distribution. So we have distributors who sell some material to ongoing projects and government. So we do not directly deal with the government agencies. Though we have the responsibility to get approval from all the government agencies as much as we can. So in a way, we do not have that percentage of sales to whom or to the government entities that we are asking for.
So basically, we do not have any stress of slowdown of payment by the government in our business, right? If I understand.
Exactly. So by having distributor in between, we have our payment terms. We have our payments visibility, and we have reduced our payment cycle also. With the government, I mean that can go haywire. So that's why we don't deal with government agency and the project directly.
Okay. And the last question on the volume visibility side for the second half. How we see the second half compared to the first half in terms of volume, and if you can give some visibility about the F27 volume. That's it for my side. Thank you.
So I believe first half, if you see the numbers also, it is historically for us it is very high. Along with the competitor who are also reporting good volume numbers for last 2 quarters. So even if there is a prolonged monsoon over all the parts of India, and even if there is the perceived slowdown in infrastructure capex by the government, still the volume in terms of private sector consumption and all is very high. We believe in the second half of this financial year also will have a similar trend of higher volume of us also, and in terms of if you see other competitors also. So for MS, we see demand will be robust for the second half of this financial year. In terms of stainless steel, we have ramped up our production to 80% of our capacity. We are doing some debottlenecking of our capacity so that we can produce another 2,000 ton per month. That is like 50% increment in our production capacity, and production of the stainless steel coil will be there from January 2026. So there is a good amount of demand from stainless steel market also. Third is GP. GP is basically there is a short supply because of the solar structure boom that is happening in India. So the demand is also very robust over there. In fact, we are also doing some process changes, so our production increased from 80,000 ton per annum to 1 lakh ton per annum. So we believe demand side, the volume side is still intact. There might be some contraction in the margin itself because of reduction in price of overall coil market, and in turns that results into price reduction in pipe also.
Yeah, hi. I had a question. What is the current situation on the safeguard duty and does it affect us? Are there any communication with the government regarding the same in terms of the prices and imports? And what is the competition from China looking like? If you could please shed some light.
So, government introduced at the end of financial year 2024, 2025, the safeguard duty. But if you see, even if there is a safeguard duty in place, the price of coil is reduced in last 6 months by let's say 4 to 5 rupees. So if you import Chinese coil to India, the price will be still higher. So Indian domestic price of coil by the domestic manufacturer is still 2 rupees cheaper than the price landed cost of Chinese import. We believe this pricing will be, will be here to stay. This because government is already working on reducing the raw material price in iron, in steel making. They are creating transport efficiency for transporting the iron or the coal to the linked plants. So we believe even if there is safeguard duty, we do not have much benefit of it because domestic price of oil itself is it is 5 years low. So that's how we look into the market, and this is the price which is going to be stay for near future.
Okay, that's it. Thank you.
Yeah, if I look at the slide number 32, the margins have come down from 15% to 10%, EBITDA margin, whereas you have spoken about cost optimization, brand building, and value-added products. So if these three initiatives are being taken, why should the operating margin be coming down?
So, primary margin, there are two reasons for it. First is monsoon. In the monsoon season, we have a higher moisture content in our raw materials, which result into our production efficiency loss in end product. Second, price of steel we supposed to be stayed, at least at above 46, 47 rupees per kg in terms of coil is now in the range of 44. So this price reduction of coil in the domestic market directly impacted our margin. So these are the two primary reasons because of which our margin impacted.
So can we conclude that your business is more of a commodity, and with the movement of steel prices, your margins will go up and down?
Yes, sir. Partly the answer is yes, partly is no. First, it is we are operating in three segments. That is MS steel pipe, then GP coil and GP pipe, and then stainless steel. So for MS pipe and MS pipe segment, we are also getting benefit or making profit out of steel making also. So definitely that part of MS steel pipe making, that is making of coil from our own production line, has some bit of commodity exposure because our raw material is coal, iron ore and pellets. Rest part, that is making pipe, that margin is still intact because that depends on what is the price of pipe and what is the cost of making the pipe. Second part is GP pricing. GP pipe and coil pricing also move upward and downward from the price of MS coil itself. So all our competitor, whoever are making this kind of product, they also reduces their prices according to the market price of MS coil. Third segment where we are operating is stainless steel. Basically, stainless steel coil is what we are replacing the import of whatever India has been traditionally importing. So that is not much of a commodity business. I would say that is more of a value-added import replacement product. So part of our business is you can say commodity exposed, and rest part, that is more than 50% of the part of our process and business is mostly value-added.
Thank you. All the best.
Yeah.
Sir, Ramesh Purvani from Mehta & Vakil. In your
Yes, sir.
presentation, you highlighted your total expansion of capacity by 1.2 million tons spread over the next 3 to 5 years. Will this be?
Yes, sir. Yes, sir.
Yeah. Will this be in the value-added segment or again it will be 50-50?
Sir, we have two things, sir. So this 1.2 million annual green steel project that we are talking about will be executed in 3 phases. Currently, we have a concrete plan for first phase of end product of 360,000 ton. It will be in the form of HR, AP and CRBA stainless steel coil. Phase number 2 and phase number 3 will also have similar capacity expansion in terms of 60,000 ton capacity each. But the product is not yet finalized. But certainly it will be value-added product, but from the full backward integration. So if you see in terms of SS coil manufacturing, we are fully backward integrated SS coil manufacturer. So we are not just the re-roller of the stainless steel coil in market. So in India, if you see, there are 3 players who are manufacturing stainless steel coil from full backward integration process. First is Jindal Stainless, who are the market leader. Second is a listed player called Rijim Steel, and third is Sambhv Steel, that is we. So we are currently having visibility of first phase of entire 1.2 million ton capacity of greenfield expansion.
Sir, with this expansion being implemented in phases, say phase 1 where we are very accurate and clear and focused, will our EBITDA margin improve back to 15% from 10% or will it be in between?
Sir, if you see steel business or our kind of business, usually give we give a margin range of 10 to 14%. In some quarter it may be 10%, some quarter it may be 12%, some quarter it may be 14%. But with addition of my stainless steel, so if you see my current production line is having actual production of approximately 20,000 ton per month of stainless steel, MS pipe, 20,000, let's say 7 to 8,000 ton per month of GP coil and pipe, and 4 to 6,000. Now it is going to be 6,000, 4,000 ton of stainless steel coil. So in this product, we are making an average EBITDA of 6,000 to 6,500 currently. But in the after implementation of first phase, which will be completely stainless steel coil, my margin may be in the range of 10 to 14%, but in terms of rupee, it will be 10, 12,000 at minimum. So if I blend that, my EBITDA margin will go upward of around 8,500. Post my first phase of greenfield project comes live. So I believe, so in terms of monetary term, our EBITDA will be, in terms of per ton basis, it will increase drastically. But in terms of percentage, we are not certain whether it will be 10, it will be 12, or it will be 14, it will be in the range bound of 10 to 14%, sir.
So with this EBITDA in the range of 10 to 14%, one can say safely around an average of 12.5% from the point of computation and going ahead as far as future finance requirement goes, will it entail a reduction in your debt or borrowing or will it not?
The 12% is for last 20 years we have seen in the steel making business that 12% is the average where we can expect ourselves over a period of time or in a yearly basis if we don't look quarter on quarter.
Yeah.
Secondly, in terms of uh, uh, business per se, if you see the raw material prices, that is iron ore, coal or pellet prices, usually having a lag effect of reduction. So first the coil price get reduced by the market and then all the raw material price subsequently within 1 or 2 quarters get readjusted to the pricing of coil. So our margin, we believe 10 is bottom at which we are operating currently, 12 is the average we comfortably gonna achieve, and 14 is the outlier number which we try to achieve by achieving the process efficiency in terms of having our own power plant, in terms of our own cost reduction method and all.
Thank you and all the best.
Hello, good afternoon. A couple of questions from me. First is my general understanding for primary producer is that for a million ton you need around $1 billion, which is roughly around 9,000 crores. You are making half a million ton capacity expansion, which would roughly around 900 crores, including power. Can you just walk me through the economics of that? How much is what part? And since you are saying that we are doing a backward integration as well, how this is going to pan out? I'm assuming that from iron ore to final product you're going to make yourself.
Sir, can you answer? I couldn't hear actually what was the question.
So I'm asking that for a primary producer, 1 million ton of steel costs around 9,000 crores. $1 billion, like, for 1 million ton of steel. You are increasing your capacity by half a million ton, and you are spending around 900 crores on it, including the power plant. So just can you walk me through what is the difference here?
Yeah, so there is a significant difference here, sir. So what we are doing, firstly, we are doing the expansion in the stainless steel segment and not in the mild steel segment. So we don't need to manufacture sponge iron for this. So there is no iron ore to finished product. We'll just procure the scrap, we'll melt it, we'll mix alloys to it, and then we'll cast it in the form of slab to HR coil, and HR coil to CR coil. So that was one difference. We don't need to set up sponge iron division. And apart from that, the coil that will be manufacturing, it will be a width up to 650 mm. So in the coil segment, the capex significantly, or you can say exponentially, increases as you increase the width. So the primary producers typically start manufacturing coils from 1250 mm width, but the R maximum width will be 650 mm. So this is one of the major differences. In the mild steel segment also, if you see our current gross block of the capacity that we have right now is around 800 crores. In 800 crores, we have set up a unit which manufactures around half a million ton of finished product, right? Because the oil width today is maximum 450 mm for us. And as we increase the width, the size of rolling mill gets increases, and the rolling mill cost much higher than what the rolling mill currently costed us.
Thank you. Just one more point. What is the lowest HRC price that you think you can profitably run the mills? Lowest price, because anyway we are seeing down in HRC prices. So what is the lowest price that you assume that okay, up to this level we can run profitable? After that probably there will be operating profit or something. We are around 500 right now.
So I'll put it a bit differently. If you see in last year in quarter 2, I think we saw the bottom down prices of HR coil, right? And we don't see, and after that only the safeguard duty was demanded and the government investigated and imposed the safeguard duty. So in that market also we were profitable and significantly profitable higher than all our peers. So in Q2 last year also the EBITDA for us was more than 4,500 to 5,000 rupees. wherein all our competitors were reporting an EBITDA of around 1,500 to 2,000 rupees. So on the bottom half of the market also,
just a follow-up.
we-
Just one of that. So, are we increasing some credit period for our suppliers or for our customers so that we can have margins and are we relaxing our working capital norms for that, or it's a normal flow of business that okay our competitors making 2,000 we can make 5,000.
No, so in the MS segment, we are not relaxing the payment terms or anything like that. So what we do, we extend a sales bill discounting facility to our distributors, wherein they get the credit from the bank. So what we typically do, we issue the invoice, we get the same discounted from the bank, so we receive the money immediately, and after 30 days, the customer directly pays to the bank. So this is how we are offering the credit cycle to them. And in the SS segment, since we are fairly new to that market, yes, we are extending credit of around 15 days to them until the market, we set up our product in the market. But I think 15 days is something that we can manage. So there is nothing that we are relaxing the payment terms to use.
Thank you very much.
Yeah.
One question on your commentary, you do indicated you started 304 grade SS production. So first question is what is the share of the mix currently in the business, and secondly, over the next let's say 2 years, 3 years, what share can go up and what is the implication of the EBITDA per ton for this product valuation?
So since we started manufacturing 304 just a couple of months back, so current share is very low. You can say around 10%. But going forward, as the market accepts that grade also, just like the market accepted 202 grade, we expect that mix to be in the range of around 60-40. So 60% would be 200 series, which is the base product, and around 40% we are targeting to produce higher grades like 300 grade or any other higher grade that will be manufactured in future. And on the implication part, so if you again, I mean, on the percentage terms, the EBITDA percentage would be of similar levels. But since the price in absolute terms for 300 series will be higher, on a per ton level, the margin would be higher, but on a percentage level, again, it will be around 12 to 30% only. So just to put in a context, the 202 grade CR coil is priced at around 1,25,000 rupees, while 304 grade series CR coil is priced at around 1,85,000 rupees.
Do we have any questions?
BIS norms for import of stainless steel have been diluted up to March. So what is the impact of that we are seeing in the stainless steel market?
Sorry, I think I didn't get the question. Because you did you hear the question?
So I was saying on imports, BIS norms have been diluted for March up to March. So what is the impact of that we are seeing in the stainless steel market?
So there are certain tendencies and payment being done and LC being opened for stainless steel coil to be imported from China. So all of a sudden government introducing the BIS norm for importing the stainless steel but to honor the business commitment which already being done. Government allowed a window of 3 months to import whatever the pendency from the whatever market they have placed the order to. So if you see the price is also being a bit corrected in terms of stainless steel market, but there is still lot of demand that is there. So that is why we have achieved our peak production last month of around 80%, and we are also debottlenecking our production, and it will, from January itself, from currently 4,000 ton per month to it will increase to 6,000 ton per month of SS coil production. So yes, price is reduced a bit, let's say 3 to 5%, but demand is still here for stainless steel coil, and there is still import being done without having PS requirement.
So any specific reason we are not in 400 series?
Sir, so we have just nascent, and we are just, you can say, just learning child in stainless steel market. It's very specific alloy which needs to be mastered properly. A single batch of error cost us 10 to 12 crore of profitability wiped out. So we have started with 200 series. We worked here in 200 series for last 7 to 8 months. We mastered that. Now we have graduated to 300 series in last 2-3 months. We are doing that. We are selling the product. We are getting the feedback from the market. In fact, we believe 400 series is easier to make rather than 300 series because it's less amount of nickel in 400 series in comparison to 300 series. So once we complete our market feedback, market placement of our production of 300 series, we may graduate to 400. Our vision is to do a higher version of stainless steel, which currently no Indian producers are making, but the shift or the graduation will be slow and upward, but it will not be sudden.
And which are the applications in which your pipe of narrow gauge is not allowed? Where only broad gauge HR coils are used, such as that of ATM or high-tech.
Can you repeat? I'm not able to hear you.
So, in which applications the secondary HR coil pipes are not allowed? Which are the applications?
So, are we talking about MS pipe, sir?
Yes.
So, sir, there is nothing called secondary pipe. So, there is two. So, there is secondary pipe which you are referring to is called patra, sir, in Hindi, which is basically non-IS grade, non-homogeneous. Patra, that is MS strip, which is being made by many Indian manufacturer. This pipe can be made up to 3 inch of 3 inch of pipe. Above 3 inch, it requires coil. Okay, so this patra pipe itself is being used in India by many small towns and many village areas. Plus, there is being used in non-load bearing structures. But if you see, what we are producing is not secondary pipe, that is patra you are talking about. It is the steel which we make from the secondary route. So if you see, steel making itself has two route of making. The primary route is called the first route is called primary route of steel making, where people use blast furnace and electric arc furnace. And the second route of steel making is where we use DRI, by which we make sponge iron, and we use induction furnace. So in this combination of DRI and induction furnace, we are using secondary route of steel making, and out of it we are manufacturing the baby coil or the narrow width coil, as you say. In terms of patra, the width of patra cannot be more than 296 mm. So the design of patra itself is because of the non-standard of the liquid steel itself and having high carbon content in that. The patra cannot be made, of more than 300 mm. Whereas we are making currently 450 mm width of narrow width coil, and going forward we will be making 650 mm of narrow width coil.
So, are there any application in which a blast furnace route is more preferred over in biosteel pipe vis-a-vis sponge?
So, if you, I will explain production process per se. Then blast furnace is usually viable for production upward of 1 million ton per annum. But DRI process is feasible starting from 1 lakh ton production per annum. So, if I have to put blast furnace, for that I require at least 4,000 crore rupees of capital, which currently I do not have. So I rather choose to be more efficient in terms of my capital requirement, and I choose DRI process. Secondly, in primary route of steel making, people use electric arc furnace where graphite electrode gets used, and with the graphite electrode, they try to control, or they control carbon content in steel, they control phosphorus and sulfur. In secondary route of steel making, in induction furnace, we do not have that luxury of controlling carbon, controlling phosphorus, and controlling sulfur. So what we do in terms is we use higher grade of iron ore and pellets from Chhattisgarh market, and that product itself or that iron ore and pellet itself have inherently having lower amount of carbon, lower amount of sulfur, and lower amount of phosphorus. So if you match my liquid steel with the blast furnace and electric arc furnace route of steel, then the chemical composition and the electric and the physical properties are equivalent, because once you achieve the chemical composition on whatever we make the steel, the physical property will be achieved automatically. Apart from that, in the rolling process, we are using HSC technology, that is automatic hydraulic gauge controlling system, which is being used by the JSWs and Tatas and AMNS. So the same technology gives us the thickness homogeneity across coil, that is from the width to length. The margin of error is very less. So the physical property is from the secondary steel or secondary route of steel making is similar to what primary route of steel making producers are currently achieving.
Thank you. Thank you, Bikashi, for your detailed answers. This is Namit Arora from Growth Capital, and many thanks to the Go India team for organizing this very useful interaction.
Thank you, sir.
Thank you, sir. So my question is, you mentioned in one specific segment two competitors, Jindal and one unlisted company, Rimjim Steel.
Yes, sir.
Apologies, I am not very familiar with Rimjim. But sir, could you benchmark yourself with Jindal in this segment and Rimjim in terms of your scale and your capabilities?
Sir, we have started with a very small quantity of 4,000 ton per month. So install capacity is 5,000 ton per month, but we are producing currently 4,000 ton per month. Jindal are the market leader. They drive more than 50% of the market of stainless steel coil. They have more SKUs than we do have. They have a lot of series they produce. They also have specialized alloy series of coil that they are producing for defense and other specific clients. Though that we do not. Where we are competing, we are actually not competing. We are actually complementing in terms of thickness of the coil. Jindal usually provide customers with above 1 mm thickness coil to the market at width of more than 1250. If customer asks, they slitting and they provide below 1250, but that requires slitting. Whereas we are producing currently up around 300 to 350 width of coil and below 1 mm thickness, and we are supplying that to the end user, that is utensils manufacturer, small pipe manufacturers and all that. So we are actually in stainless steel market complementing Jindal stainless steel, where they are not producing or they are not providing the material. We are producing and providing that material and supplying it to the customers. Going forward, with this new facility, wind-free facility, our width of stainless steel coil will increase from 300, 350 to 600, 650. Again, in this particular phase, we are planning to sell 50 to around 50% of our coil in HR form, and the rest 50% of our coil in CR form, that is below 1 mm of thickness. In fact, we are now eligible for specialty grade of stainless steel coil for 1.2 PLI scheme that has been launched in 5th November 2025. So we are going forward going to produce not only below 1 mm, we will be producing 0.1 mm thickness, which is a very precision thickness stainless steel coil and having very specialty use. So with our new plant, we will be producing 0.1 to 0.1 mm to 1 mm thickness of coils.
Very helpful. Thank you for detailed answer, Vikasji. My final question is at the company level. Now, you rightly mentioned that you are being strategic about your capital and you are avoiding things like the 4,000 crore possibility on capex, etc. So, if you take a next 3 to 5 year view, it may be too early, but do you have an overall sort of capex in mind?
So currently, this phase 2 this particular greenfield that we have announced require around 2,200 to 2,500 crore of capex in overall for producing 1.2 million of installed capacity and product. So this will be, these capex will be completed in next 4 to 5 years, and it will be in the form of mix of debt and equity. So whenever I will be, that is why we have planned in a phase manner so that the debt will not be very high, because in this 5 year I will be generating some free cash flow out of my business, which I will keep deploying for my capital expenditure of this 1.2 million install capacity greenfield project I'm talking about. Apart from that, we may have certain a small amount of capex that we may announce in future, like the announcement of 25 megawatt power plant that we have announced this year. This will basically, suffice me to have self-reliant on 100% of our power plant power requirement in unit one, that is Sarora, where we have sponge plant and all. So going forward, we wanted to be self-reliant on power requirement of our all the manufacturing plant, because in Chhattisgarh the power cost is day by day increasing, and this itself, and since we have been running power plant for last 7 to 8 years, so we know the nitty-gritty, we know at what cost we can produce the power. So we believe there is an alpha of around 4 rupees to approximately 4 rupees per unit per unit of power that we are producing, and vis-a-vis what we are pulling it from the grid. So this 4 rupees in terms is a very big benefit. In terms of margin, it may be upward of 2 to 3%. So we may have certain capex related to power. Secondly, we are also working on certain value-added product of stainless steel segment, which is apart from this greenfield project. So once our market study, our technology study, and in terms of our customer study gets completed, we may come up with some new product and new announcements. But it will be not in the thousands of crores, it will be very minimum.
Thanks a lot, Bikashi, for your detailed thoughts on all questions, and all the best to the entire team. Thank you.
Thank you very much, sir.
Do we have questions from the audience?
Hi, thank you for the opportunity. Can you break down your
We are not able to hear you.
Hello, am I audible now?
Yes, sir.
Can you break down the overall EBITDA per ton basis different part of your value chain? Like how much profit do you make or do you save by doing everything in-house?
Sir, between us and the regular manufacturer of pipe, there is a basic difference that we manufacture our own coil to make pipe up to 5 inch, or let's say up to 350 mm dia. So we are in our margin, there is a margin related to steel making that is included. Vis-a-vis, if you see others, they have a margin of only making pipe. So that is the basic difference. In terms of EBITDA per ton, product wise, we usually do not have that accounting system which will give us product wise or segment wise profitability or per ton profit EBITDA margin. But overall, if you see, along with my stainless steel margin, which is upward of around 14 to 15,000 rupees per ton that I am currently getting, my blended EBITDA for last H1 will be approximately in and around 6,500.
Sir, but you sell some intermediate products to the market as well, right? So can't we gauge profitability for those products? This is the sales that
Sir, if you see, that is why I specifically mentioned for stainless steel, I can give you a number that is like 50. So if I say this way, I'm expecting a EBITDA of around let's say 250 crore rupees this year. I'm expected to make around 60 to 65 crore rupees from stainless steel division, and from MS and GP division, I'm expected to make around 185 to 190 crore of profitability. So in terms of per ton, if we back calculate, it will be let's say around 5,500 to 6,000 rupees from the MS segment, that is MS pipe and GP, and around 13 to 14,000 rupees from the stainless steel. So overall, it will give a range of around 6,500 to 7,000 rupees.
got it. Thank you.
Any more questions? Anyone? Hello. I just wanted to ask the revenue mix according to the product categories like for ERP pipes, HDPE pipes, access points. What is the revenue percentage for each of the categories?
Sorry, you are not audible.
I wanted to ask the revenue percentage category wise sales breakup for each product category, ERW pipes, GP and SS coils.
So, if you see, so the total sales volume was around 1,91,000 metric tons. And out of that, the intermediate product was just 22,000 metric tons. So around 1,70,000 tons was finished product, which is more than 80%. So out of that 170 also around 1,08,000 was from the pipes and tubes segment, black pipes and tubes segment. Around 40,000 tons was from the pre-galvanized coils and pipe segment. And around the 10% of the total sales volume as of today, 10 to 12% is coming from the sale of intermediate products. Rest 90%, around 90% is from value-added products.
Uh, so, so what is your target for next year, till FY28? The volume guidance?
Volume guidance. So see, the current year's volume guidance, so in H1 we achieved around 1,90,000. So in this year there is no significant capacity addition, so we can extrapolate the volumes for this year. And 3,60,000 is something that we are adding. So out of that 360, if we consider the utilization of that, around 2,40,000 will be added to our sales volume. So what we can assume is 380 plus 240. So around 6 lakh to 6 lakh 20,000 metric tons after we commission our phase 1. This is the volume that we are expecting.
Okay, and I just wanted to ask your market share for the ERW pipe segment.
Rashi, we can't hear.
Market share for the ERW pipe segment. What is your current market share for the ERW pipe segment? Okay, thank you.
Yeah, I think we didn't hear you that. Just answer the question once.
Yeah, so the current market share is at around 2.5 to 3% that we have as of today in the MS pipe segment, ERW pipe segment.
Okay, any more questions? Okay, so I think we'll end the session here. Thank you, Sambhv team, for making your presence here during after all the difficulties. So thank you.
Thank you everyone.
So the next session will start at 1:45 p.m. and at that time you can also try the goodies here from Heritage in the lunch break. We have